Have you ever wondered what keeps the entire world of business from just falling into chaos? Well, it turns out it's a system, an invisible engine that powers all modern finance. And today, we're going to pull back the curtain and show you exactly how it works.
I mean, just think about it for a second. Without some kind of trusted system, it would be the Wild West. Companies could just invent numbers out of thin air. How could you ever invest your money, or get a loan, or even trust that taxes were being paid fairly? It would be a complete mess. You've got to have a system you can rely on.
And lucky for us, the solution that brings order to all that potential chaos is an incredibly smart, two-sided system that was thought up centuries ago.
It's called the double entry system. Now, at its heart, the idea is actually pretty simple. It says that for every single thing that happens with money in a business, there are always two sides to the story. It's not enough to just see money come in, you have to know where it came from. It's not enough to see money go out, you have to know where it went.
And this system has one golden rule, one law that can never, ever be broken. Total debits must always equal total credits, every single time. There are no exceptions. This is the simple, powerful idea that keeps the whole universe of accounting perfectly in balance.
Okay, so you hear these words debit and credit all the time. What do they actually mean? Let's make it easy. Just think of a debit as where value flows to, and a credit is where value flows from. So if your business gets cash, you debit the cash account because that's where the value went. The credit then tells you where it came from. Maybe a loan? That would be a credit. See? Two sides of the same coin.
Now, all this balancing of debits and credits, it's not just some accounting game. The whole thing is designed to protect one core, fundamental, and totally unbreakable equation. And this is it, the big one. Assets equals liabilities plus capital. Or, in plain English, everything a business owns has to equal everything it owes. And it owes that value to two groups: outsiders, like lenders, which are the liabilities, and its owners, which is the capital.
Let's see this in action, right? Let's say an owner puts $10,000 cash into their new business. Okay, so on one side of the equation, the company's cash, which is an asset, goes up by 10 grand. But wait, it has to stay balanced. So on the other side, the owner's capital also goes up by 10 grand because the business now owes that value back to its owner. Both sides of the scale move up by the exact same amount. It stays perfectly balanced.
All right, theory is one thing, but let's see how this actually plays out with everyday business stuff. We're going to run through 3 super common examples to see how the system handles them.
So first up, that owner investment we just talked about. The business receives cash, so its cash account gets a debit. Where did that value come from? The owner, so the capital account gets the credit. You see? One entry for the thing you got, one for the source of that thing.
All right, next. Every business has to pay rent, so cash is going out the door. That means your cash account, which is an asset, is going down. That's a credit. But where did that value go? It went towards an expense, your rent. So the rent expense account gets the debit. Again, the two entries tell the whole story.
Okay, now for one that trips people up sometimes. What happens when you buy something on credit? I mean, no actual money has moved yet. Well, the business received goods, right? So its purchases account gets a debit. But since they haven't paid yet, they now owe money. That's a new liability. So the creditor account gets the credit. It's amazing. Even with no cash involved, the system still balances perfectly.
So you've seen the how. Every transaction, a debit here, a credit there, always in balance. But you might be thinking, why all the fuss? Well, this is where the real power of the system comes in. It's not just about bookkeeping, it's about clarity and truth.
This is the payoff right here, because everything has to balance. It's like a built-in error checker. It makes it really, really hard for mistakes or even fraud to hide. If the books don't balance, that's a huge red flag that something is wrong. This simple idea is the absolute bedrock of all reliable financial statements.
And what this all boils down to is a single, powerful promise that because of this rigorous system, a company's financial statements can present a true and fair view of what's really going on. It's all about creating trust that you can actually verify.
And honestly, this system of trust, it's pretty much what our entire modern economy is built on.
You know, people literally call it the backbone of financial accounting. And they're not exaggerating. Without it, the whole structure of modern business as we know it, from getting a bank loan to trading on the stock market, it would all just fall apart.
And here's the really cool part. This isn't just for giant corporations. From the little coffee shop on your corner to the biggest tech companies in the world, they all use this exact same logic. In fact, anytime you use accounting software, no matter how simple it looks on the surface, this is the powerful debit and credit engine that's working tirelessly behind the scenes.
So there you have it. You now understand the fundamental language of business. You get the rules of the game. So the next time you look at a company's financial report, the real question isn't just about the numbers themselves, it's what story are those perfectly balanced numbers trying to tell you?